Hello, oracles. Oh my goodness. We have Tesla that is still rocketing pre market today. We have Tesla up almost 3%. We're going to go over some of the reasons why we are up again pre market even more. And we're going to go over today some of the positive and negative catalysts, some things that we can see to the upside, and some things that we can see to the downside that can cause us to move one way or the other. And we'll go over those today. And then you guys can let me know at the end which way you think we are going to go. All right, so taking a look at the charts here, pre-market we are up to 207.95, up just over 3%. So awesome way to start the day. Yesterday we closed over $200. That was a huge level to close over. So closing over 200 was big. And so we're going to now get into the reasons why we have been climbing the way we have been climbing, and then some of the things that may end up causing us to pull back. And so, as we had discussed yesterday, the Tesla Model Y is the best selling vehicle in California. The Model 3 is the second best selling vehicle over there. But there's a lot of other catalysts that we just got very recently that might actually be non Tesla related that are causing the stock price to move up. So, one of the first things that are out there is something that Elon had tweeted a few days ago. Last 3 months were extremely tough, as had to save Twitter from bankruptcy while fulfilling essential Tesla and SpaceX duties. Wouldn't wish that pain on anyone. Twitter still has challenges, but is now trending toward break even if we keep at it. Public support is much appreciated. So while many of us noticed over on Twitter yesterday that Twitter was closer to breaking rather than break even, Elon is focusing on getting them to profitability. That there removes the potential that Elon's going to have to sell more shares of Tesla stock just to be able to float Twitter along. Now, Elon did state previously that he wished he did not have to sell as many shares as he did. Again, it's a human mistake. He made it. He owns it. That's what it is. But he still wishes he didn't have to sell as much as he did. And now we're at a point where it looks like he's not going to have to sell any for Twitter at all in the future, as they're already close to break even. And another positive catalyst we have is Sawyer Merritt coming out tweeting, breaking, SpaceX president and COO Gwynne Shotwell says the company's Starlink satellite internet program had a cash flow positive quarter in 2022 and will make money in 2023. Starlink's subscriber count went up 4x between March and December. And as many people think, we might get a Starlink IPO relatively soon. I don't know if it's going to be coming this year, maybe in 2024. Chamath seems to think that it's going to actually be coming in 2023. We shall see, but profitability on Starlink is huge. And while it's not directly related to Tesla, we do know that there are inner workings between the two of them. And because it's one of Elon's companies that is also becoming even more successful, that just moves up the entire Elon brand to go in that positive direction. That puts positive light behind Tesla also. And when you just straight look at financials, we've got Charlie Bolello coming out showing sales between Legacy Auto and Tesla. So sales 10 years ago, GM was 152 billion, Ford was 134 billion, Tesla was zero point 0.4 billion. Today, sales for GM are only up 5 billion to 157. Ford has climbed nicely to 158 billion, but Tesla is up to 81 billion dollars. Now, if you look at just those numbers alone, you say, well, Tesla is still small compared to Legacy Auto. But when you remind yourself that you pay your bills with net income and not with sales, you take a look at net income from 10 years ago, GM was at 6.2 billion, Ford was at 5.6 billion, and Tesla was losing money 10 years ago at negative zero point 0.4 billion. Today, GM is making $10 billion. Ford is now negative at negative 2 billion, and Tesla is leading the way with $13 billion in net income. And then you need to also remind yourself that Tesla is growing significantly faster than the other two as well. The other two are in the process of switching from ICE vehicles to EVs. That is going to be a very expensive venture that they need to make in order to survive long term down the road. Meanwhile, Tesla is going to be churning out higher and higher profits than both of them. And as we have seen, Tesla is already bringing in more net income than the two of them combined. And I can see this continuing in the future, especially as we are starting to look at energy numbers really starting to take off as well. So if Tesla is beating Legacy Auto at auto, what's going to happen when Tesla also adds energy into the mix where Legacy Auto does not have that as an option? Oh, and by the way, Tesla also has AI. Tesla also has FSD. Legacy Auto does not have either of those. They will be outsourcing for both of those most likely. And while GM and Ford both are working on some sort of self driving program, they're nowhere near where FSD is right now, and so we will see how that plays out over time. So, overall, from a Tesla standpoint alone, there are many positive catalysts. And again, March 1st with Investor Day has who knows what we are going to find out that day about energy, about a new production process that they're working on for the Gen 3 platform, perhaps a new smaller vehicle. We've got the Cybertruck coming up. Absolutely outstanding catalysts on the upside for Tesla. But now we're going to take a look at the downside because you need to be realistic and look at the entire picture. The downside of things, most of which has to do with the macro environment. Tesla specific margins, we could start taking a look at, well, margins with the Model Y pricing going up could be a very good positive catalyst for the company. But if they do come down a little bit because they gave such a big discount on their vehicles recently, we may see lower than expected margins for Q1. That could be potentially, from Wall Street's standpoint, a negative catalyst. But that again won't come until April when we get the Q1 numbers. And so, looking at a macro environment near term catalyst that could bring us down, we've got Open Skies coming out sharing CPI consensus for next week. By the way, CPI is coming out on Tuesday, February 14th. Not sure how they reconcile a 0.5% headline month over month CPI. Doesn't sound disinflationary. So we've got estimates for that month over month of 0.5%, whereas last month we were at negative 0.1%. 0.5% annualized is a 6% inflation number, which is still very high, considering the Fed wants to get us down to 2%. The year over year estimate is 6.2%, whereas last month we were at 6.5%. I was hoping we could get a 5.9 to 6.1, but the estimates are now coming in at 6.2. When you're looking at core month over month, we are looking at last month of zero point 0.3 and this month an estimate of 0.4%. And so some higher inflation numbers that come out could kind of spook the market a little bit. We know that when we see high inflation, it is growth stocks that take the biggest beating. Tesla is the leader of all of those growth stocks. So, does this push that we have seen recently, is that a little bit exaggerated due to FOMO and we are going to get a little bit of that bubble getting popped if we get higher inflation data? Again, I don't know what's going to end up playing out. This is just the estimates based upon right now. We will update those on Monday and see if any of those estimates change. But there are also some other catalysts out there that are kind of giving some macro environment signals that we may end up seeing a pullback at some point soon. Another one of these catalysts is Unusual Whales coming out saying 72% of institutional traders don't plan on touching crypto this year, worried about volatility, a recession like macro environment, and liquidity concerns, according to an e-trading survey from JP Morgan. We also have Unusual Whales coming out saying that US credit card debt has hit a record $930.6 billion, and credit card balances climbed more than 15% from a year earlier, the largest annual jump in more than 20 years. And if you match that up with the 64% of Americans are living paycheck to paycheck, a near all-time high, and this is people that are making over six figures. And you pair that with JP Morgan data shows retail investors' share of trading orders for stocks and ETFs hit 23% of total market volume in late January, eclipsing the peak of 22% seen in the original meme frenzy in 2021. US retail investors on Monday, January 31st, had the biggest day of the year, buying $1.8 billion worth of stocks despite uncertainty of the Fed's rate decision. And so, for me, what all of this points to is the fact that a lot of the movement that we have seen in the stock price and in the market recently is a lot of retail investors. Yes, some institutions have been buying little bits here and there. They have been pushing up the volume quite a bit. But we do know that Tesla is heavily bought by retail investors and is heavily bought in options. When you put those two things together, you start to get these kind of runs like this that are also driven by a lot of FOMO. And we have seen this. This is one of the reasons we hit a massive bubble during the last 2 years because a lot of people were buying options and using a lot of margin. I don't know how much margin is being used for all of this right now, but knowing how retail investors are, people are living paycheck to paycheck, and it's mostly retail investors that are putting money in the market right now. This is just leading me to believe that something has to crack at some point, And because of the fact that it's retail investors that have really pushed up the stock price to where it is now, if they end up cracking, we may end up seeing that falling down. And so if we end up seeing inflation kind of not slow down to where we thought it could be, that could be the breaking point for a lot of retail investors. More and more people can't pay their bills. Eventually, they might end up having to sell out of their stocks in their portfolio just to pay their bills because they're going to be maxing out credit cards. They're not going to have as much money to spend. They're going to be going deeper into debt. This is something that I try to help other people with. It's something I have gone through in the past and worked through, which is why I'm at a place where I'm at now, going from $75,000 in debt 5 years ago to a six-figure net worth now. That took a lot of discipline and getting rid of a lot of that debt. Some people seem to be cycling back into that could create a bubble that could be popping. So, not to say that we're in a bubble, and I don't think it's going to be anything like we saw last year, but these are just some of the macro signs that I'm looking at that could kind of indicate that we might see some sort of pullback coming. So, again, we're looking at the upside and the downside. Most of this upside is Tesla related. Awesome, awesome stuff. Long term, it's going to be amazing. But there's also that downside risk with the macro environment, and Tesla truly can't take off to where it needs to go until the entire economy gets to a healthy place itself. And the entire economy is not in a healthy place yet. And so that is my take on the upside and downside for Tesla and the entire market and the economy. You guys can let me know in the comments below which way you think we are going to go. My personal take on this is the same as it has been. I think near term, we see a pullback. Near term, I think we are going to see some great buying opportunities. I do not know how low we go. Again, I usually follow the gaps for that. The lowest gap above $100 is down at that $114 level. People think I'm crazy for even mentioning it, but that is one of the areas that I look at down below us. But then I also think on the upside long term, Tesla is going to be absolutely outstanding. I had mentioned it yesterday that I'm going to be updating my valuation model and including a lot more of this energy. I had energy ramping a lot slower. I am going to bump that time frame up, and that is going to be adjusting a lot of my price targets. Near term, maybe still stay the same because the macro environment is still heavy. But when we go 2, 3, 4 years down the road and then longer beyond that, my price targets are most likely going to be jumping up because I think energy is going to be a lot bigger than what I have currently worked into my valuation model. So yes, it is totally possible to be bearish near term and bullish long term. That is actually normal and realistic, especially for the economy that we are currently in right now. This is the mentality that people would have had about Apple back during the housing recession is near term, great buying opportunities, and bearish, long term, awesome for the company. This is what we are seeing right now when it comes to Tesla. And that's why, to me, this is one of the greatest buying opportunities we can see for the next decade. Thank you guys all so much for watching. I appreciate all of your support. If you have not subscribed, please hit that button down below, and we will see you in the next one.